That record run for risk assets confronting that Rorschach test of the latest U.S. jobs report. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
You know, I was a little skeptical of like today. I was like, it looked like I got proven wrong. But now the Russell's coming back.
Yeah, it's coming back a little bit.
It's coming back. There's something going on. I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. So you definitely saw a bottom earlier in the day for markets overall in all the major indices. And like I mentioned, you have the Russell and the equally weighted index really kind of clinging on to positive territory while the S&P is down by 0.2%. And talk about where the risk is. Take a look at Bitcoin, another record high. It was over $70,000 at one point today. So there is risk to be taken on in the market. A touch of buying in the front end. That, of course, is because of the jobs data. And the dollar index falls, but again, off the lows of the session, down 0.1%. You know, Romaine, it's still a buy the dip. It is still a buy the dip no matter what happens.
Yeah, still some softness, though, as we get closer to the close, Alex. I've been sort of keeping a close eye right now on that, basically that 5-day average, I should say, because we are setting up for what could be a 16th week of gains over the past 18, but it's looking tenuous right now. Remember, it's been a phenomenal run so far, but it has started to look somewhat exhausted. Remember, the S&P up by 25% to yet another record high, at least as of earlier this week, but a lot of concern out there that investor sentiment may be turning. You saw that in the flip-flop in the price action earlier today, a big bump up and now a big drop down. You saw that in the AAII sentiment indicator released yesterday, a bear market reading that has dropped to levels that historically suggest a market top. Now you add in the latest Bank of America flow data, which showed technology stocks suffering the largest outflow on record in the week through March 6th. That's about $4.4 billion pulled from tech funds. That was a retreat that helped to push shares of Apple and Google into a technical correction, where they stand right now here as we move closer to the close. But there is a bright spot out there, and it has something to do with what Alex was talking about yesterday, a material broadening of the market gains this week. When you adjust the market cap weighted S&P 500 to give an equal share to each stock, you do find a bullish signal there. It's for those investors who have really been questioning how much further this rally can run. Consider this. While chip stocks like Nvidia still dominate the gains that we've seen this week, the biggest individual percent gainers this week also included names like Target, Newmont, Citizens Financial. It included 52-week highs for companies like Oshkosh, GE, Lamar Advertising, and included all-time highs for names like HCA Healthcare, Progressive Insurance, and Caterpillar. That is breadth. And that brings us back to the economy and a labor market report this morning that's generated a lot of conflicting thoughts on whether it read bad or good. Better than expected job growth, Alex, but worse than expected numbers when it comes to the unemployment rate and wage growth.
And the reason why the unemployment rate kind of spooked people out is it's approaching that 4% level. And the idea is that the Claudia Sahm rule, which we'll go into that in a second, the idea is that if you get to 4%, the level will be triggered. Now, that's not the actual rule. It's actually, if you take a look at the 3-month average for the national unemployment rate, so the U3, the 3-month average, if that rises by 50 basis points or more relative to the low during its previous 12 months, that's the key, during the previous 12 months. Now, if that goes 50 basis points, that's the problem. But it's only at 27 basis points. So we're not there yet. It doesn't have to be that 4% threshold. It's going to be probably a little above that 4% threshold. So we're not there yet. So sure, Romaine, we got that tick higher, but maybe it's okay. Maybe everything's going to wind up being okay.
Yeah, maybe. We all know that sort of one data point does not necessarily make a trend, but what does the trend say? We had a chance to catch up with a lot of folks right here on Bloomberg Television and get their thoughts on today's payrolls print.
I'm honestly paralyzed. I wouldn't know what to point to. This is an ambiguous report.
I would err on the side of this being generally a positive story.
But markets have priced-in expectations, and that's why I see this ambiguous as opposed to simply positive.
Nothing is really alarming, but it's headed in the right direction, and I think that's what the market wants to see.
The Fed was looking for some more good news, to quote Chair Powell. And I think this generally gets you there.
Interest rate cuts are still very much in the picture. The market's pricing in the summer, and I think that's quite reasonable.
People love to criticize the Fed, but wow, you know, it's hard to look for fault in their behavior really through this cycle.
A lot of great guests that we've had on the big program here on this Friday afternoon, continuing our coverage right here on The Close with Julia Coronado, president and founder at Macro Policy Perspectives. And Julia, I think everyone has a slightly different take on this report, but do you think that the overall trend, the trend that we have been talking about for the last few months, is still intact?
Well, if the trend that we're talking about is a very gradual cooling and rebalancing in the labor market, I would say yes. The job numbers continue to run strong, but under the hood, the details do suggest some cooling. One of the dimensions that's very interesting is we've talked a lot this cycle about labor hoarding. What labor hoarding looks like in this data is that companies can hold on to people, but they're cutting their hours. So hours worked have basically been flat in January and February. We've had no growth in total hours worked in the economy, but we've added jobs and cut back on the average work week. That's an interesting dimension that does confirm that employers are able to do so without losing these employees or worrying about losing these employees, which suggests that the labor market isn't quite as tight as it used to be.
What ends up being the net effect of that on overall economic activity, economic growth?
Yeah, I mean, you still have take-home pay growing, but the fact that hours worked are not growing despite more jobs means that that growth has slowed. So growth in take-home pay has moderated. It's still fine. It's still solid. What I like in this report is also that the base of hiring has broadened out a little bit at the start of the year. It wasn't just leisure and hospitality, state and local governments, and healthcare. Those have been the big three drivers through most of the second half of the year. And we've got a little bit of a broader base. But yeah, take-home pay growth is moderating. It's still solid. It's still beating inflation. That's good for resiliency. Mm-hmm. But again, there's not a lot of heat here. And just one point on the SOM rule, it's a good thing we haven't triggered it yet, because once you trigger it, that says you're already in a recession. So we don't want to use that as a leading indicator. Once you're there, you're in a recession. So we are not in a recession. And one does not look imminent, but we do have looser labor market conditions and signs of cooling.
Right. I brought that up, Julia, because some economists are pointing to the fact that we are near to triggering it as a reason for why we're going to see that slowdown. But if we're farther out, then we're farther out. So the way I feel like you're describing the job market is that, like, it's okay. So
it's okay. It's okay.
If it's okay, well, hang on. Yeah. If we're okay and the Fed cuts 3 to 4 times this year, how hot can the economy then get? Well,
that's where trend is the question. The trend is towards cooling. Aggregate hours worked are growing, 0.7% over the last 3 months. That's not a lot of growth. So if that keeps cooling, you're going to hit a turning point where consumer incomes will stop growing, or you're going to see actual job losses. Do you need rate cuts to offset that cooling trend and stabilize it and keep you on track? I think my answer to that is yes. I don't think 5.5% is a neutral rate. I think you are seeing companies being more optimistic, partly because they're more in the driver's seat with managing their workforce again. And a lot of them, the hiring intentions we see in the earnings season are not that robust. Companies are looking to be very cautious and conservative in adding workers and ramping up the labor side of the input. So, that tells us that the labor market is closer to a point where things could weaken. I think the Fed is going to need to deploy its tools. And again, if it can do so judiciously and in time to kind of keep things on track, rather than if it cuts, will we get a boom? I don't think that's the case. I think money is expensive, money's tight, and the lags from policy are kicking in. It's not always obvious in exactly where, but overall what we're seeing is hiring demand for labor is cooling down.
So Julia, as we wrap it up, you think that 100 basis point cuts this year starting in June, is that a fair assessment based on the data that you have so far?
Yeah. Our own forecast is for 125, so steady pace starting in June of 25 basis points a meeting, partly because we do expect after we get through this kind of beginning of the year noise that inflation will do what it did last year and drop down to a new range and really outperform the Fed's expectation.
All right, Julia, always great to talk to you. Julia Coronado there, president and founder At Macro Policy Perspectives, helping us kick you off to the close here on this Friday afternoon. Coming up after the break, Nvidia. A closer look here at that stock after adding more than $1 trillion in market value this year alone. Is it time for the hottest stock to split? We've got the story on who says yes and why.
Plus, Bitcoin hitting 70,000. It's a round number. We're going to dig deeper into crypto stocks in today's Stock of the Hour.
And more bad news for Boeing. 3 malfunctions being reported just this week alone. We're going to have more on that tire loss that, of course, everyone was keeping an eye on, and what we're looking at right there on the screen, an engine fire, battering a flight just overnight. All that and more coming up in just a bit. This is The Close on Bloomberg.
Gold rallying to a fresh record high today. I mean, it's really crazy. Over $2,100. The precious metal climbing for an 8th straight day. And apparently fueled by hopes of rate cuts by the Fed. Invesco Senior Commodities ETF strategist Kathy Kriske joins us now. Is that it really? Like, Fed's going to cut, let's bid up gold to 2,100? Like, is it as simple as that?
Somewhat. I have to say, though, I like gold for 3 reasons. One is central bank buying, right? It's real. The de-dollarization move is real, and we see it consistently. They do tend to buy on the dips, and even though it's not moving it higher, it has provided a floor. But also, obviously, the Fed lowering rates. So when you think about people, what are they going to use with their reserves? They're going to either use treasuries or gold. Gold doesn't yield interest rates. It doesn't yield any interest. So the fact that the rates are going down makes people want to choose gold. And lastly, I love it as a safe haven hedge. We have 2 active wars. So as a safe haven, yes, I think it makes perfect sense.
I joke sort of that like soup cans and gold, like under my bed. Like that's sort of where I sit. However, with prices this high, there's got to be physical destruction, right? Physical demand destruction. Are you watching that at all?
Well, we haven't seen it yet, and that's what gold is actually under-owned from an ETF perspective. Remember, a lot of people sold out of their gold. So from an ETF perspective, we are seeing increases, and we think we're going to continue to see that.
The correlation between what the Fed is doing, interest rates, and gold, that's pretty well known historically. What about the correlations with other commodities, particularly industrial commodities? Is there something we can draw from the potential for Fed rate cuts and maybe what we should expect in those prices?
Actually, I love this story because we've done a lot of analysis on this. Like when you look at past Fed easing cycles, what happened to commodities? And we were very happy to see that commodities did really well. So we looked at the past 5 rate easing cycles, and actually commodities on average were positive before and after, which I thought was very interesting. So, and if we look back at one particular year, 1995, so the Fed lowered rates, but their motivation was not a looming recession or high unemployment. It really was just low GDP. So they lowered rates 75 basis points over a year. And what happened to commodities? Commodities were up about 20% for that period.
It's funny you bring up 95 because this is also kind of that easing cycle that Jay Powell has alluded to as kind of his holy grail. That was when Greenspan really stuck the landing, or at least that was the perception here. So for those of us who aren't as smart as you, explain to me why, if the Fed is cutting and they're easing, why would things that are directly tied to the health of the economy do better?
Well, think about it. When you have more money, you're buying more things, right? So you're buying, especially for industrial metals, people start to build. As you gain confidence, you're going to fix your house. You're going to buy some of those durable goods, right? That will stimulate demand for commodities, right? And some of the other concern is, does this cause inflation? But generally, you look at industrial metals right now, they're down 20% for the past year. So we think that industrial metals will benefit largely from this easing.
Well, and also to your point, Romaine, it also depends probably on like the why, like they're going to be cutting. Like if it was like the Great Recession situation, that's really going to be a different demand pull than otherwise, I'm guessing. What about Bitcoin? I mentioned there's a big, nice round number, 70,000. Do you cover it? Because that would tell me a lot.
Do you have that under your bed too?
Bitcoin? No, I don't understand it. What are you, crazy? So like, do you cover it as a commodity strategist?
Yes, and isn't that funny? I remember when one of the head ETF people said to me, well, you know, commodities, Bitcoin's a commodity, so it's under you. So I joke and say, we've been in crypto college for about 8 months now, and we have a product out there.
I'm sorry, does Gary Gensler know it's a commodity? commodity?
I think he started all this.
Sorry.
But we did. We have BTCO is our ticker, and we partnered with Galaxy, right? So we're an ETF expert. Galaxy's a digital expert. So we're one of the ETFs that has a partnership that no one else has. So we believe we're in it for the long haul. We know it's been a challenging time, but remember, it's not just what's driving, like the ETF demand is not just driving the price higher. It's also the halving, which is coming up, right, in April, right, where Bitcoin miners are going to be paid half as much as they were paid previously. So that controlled amount of supply, we know a lot of investors saying, like, we want to get in beforehand, but even we joke about this, like the older generation versus the younger generation. You know, when I go talk to clients, all the younger people are, oh, I'm already in it, right? Whereas the older people are like, teach me, right? So that's where there's a big move now in education. And I love that. It's exactly what happened with commodities. Remember, Alex, you've been in commodities for a long time too, right? And that just to get that 5% allocation, we did a lot of work in educating everybody about what moves commodities, what drives commodities. We're doing the same thing now with Bitcoin. And again, we're suggesting about a 1% allocation to Bitcoin, but it's really that education that gets people off zero, getting off zero to that 1% and to see what happens. And again, it's high. We know it's challenging to buy something when it seems very overdone. But again, dollar cost averaging, buy in bits at a time, and I think people will be happy over long term. Same story with commodities.
Yeah, I was going to say exactly the same story with the gold ETFs, like back in the day for sure. All right, hey Kathy, thanks a lot. Really fun to catch up with you, Invesco Senior Commodities ETF Strategist Kathy Kriske. Thank you very much. Do you have Bitcoin, gold, and soup cans under your bed?
Not the soup cans.
Okay.
I mean, as you know, I've been a gold and silver bug for years, and maybe that's
I didn't know
a
that.
generational thing. But it also gets to the idea, though, too, is like if you are buying this stuff as a store of value, do you do that with something like Bitcoin that does have a supply issue and is going to have a bigger supply issue as more people gravitate to it?
You have to handle the volatility, I guess.
Yeah.
Is it when you just like sit in it forever and like don't worry about it and use it as that store of value, or do you have to be active about it?
No.
And what if like Ether becomes an ETF? Isn't that going to kind of change the
You
game
just blew
too?
my mind, Alex Steele.
Yeah, all right, coming up. Nvidia's scorching rally has added more than $1 trillion in value this year alone. More on the potential stock split, what it could mean for the AI giant. Coming up next, this is Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Carvana. RBC upgrading the stock to sector perform and doubling the price target to a street high, $90 a share. The analysts saying clear improvement in unit economics has taken most of the risk off of the table. And he adds that the company's cash generation per car sold may actually be better than a lot of investors realize. Investors waking up to that today, up about 7.5% on the shares. Next in line, Vail Resorts. Bank of America downgrading to neutral from buy, citing risk to the company's fiscal 2024 guidance as visitation remains weak. Analyst Sean Kelly also lowering his price target to $250 from $285. Those shares also moving lower on the day by about 0.5%. And finally, General Electric getting a jolt of energy with an upgrade to overweight. This over at JP Morgan, with the analysts seeing GE as the premier large cap name in commercial aerospace. That is with regards to its business, where that business is in the cycle, the balance sheet, and the management team. Those shares moving higher as well, right off their highs of the day here, and those are some of our top calls. All right, let's turn now to the hottest stock of 2024 and, well, the hottest stock of 2023 and maybe beyond. Nvidia, the chip maker's scorching rally, has added more than $1 trillion in market value this year alone, sending it well above the level where it last split its shares, leading some to believe that the AI giant is well placed to do so again. Carmen Reinecke joining us right now, Bloomberg News reporter, to talk a little bit more about this. And Carmen, kind of set the scene for us. I mean, a few years ago, we were in this position where people were talking about an Nvidia stock split. What is similar today than what we saw then?
Yeah, so basically we've had an incredible rally in Nvidia. Not only did it go up 240% in 2023, but it's up another 80% this year, and it's gone well past the level where it both announced a stock split in 2021 and then actually split its stock. That was about the $600 per share level and then $750 when it actually split. So what we've really just seen is that this rally has been really strong. It's been pretty blistering. It's added so much in value in such a short period of time. And what's interesting is that the last time it split its stock, it did a 4-for-1 split, and the reason that it cited was accessibility for both its employees and retail investors. So now that we're looking at share prices well into the 800s, that's something that some investors are saying, now might be the time for another split for Nvidia.
Why is the stock down though today? I mean, 4%, it's like nothing, right? If you take a look at like where the run has been, but
yeah.
Is it just profit taking just because it's so pricey?
We think it could be that. I mean, it's had a really incredible rally. Even just over the last 6 days, it's up more than 19%. That's huge. It's more than $370 billion in market value added. So I think it makes sense that people might be wanting to take up a little bit off the top. It's also at all-time highs. It just has kept climbing higher. There could also be a little bit of weight coming down. I mean, the entire semiconductor index is down today. We had results from Marvel and Broadcom that weren't exactly what I think investors were hoping for. So it might have been a good, time to just say, all right, we'll take a little bit off the top. That being said, I mean, Nvidia, it's just up so much this year. It's interesting though, even a 4% swing in Nvidia is so huge for the broader market.
Yeah, but there's a competitive aspect to this as well. Because when I saw your story this morning, the first thing I did, I started to ask people like why? What's the point, right? And they made the point. Everyone's fishing around for that next, big AI stock here, and you have a lot of retail investors who are going to look at an $800-900 share price, maybe $1,000 share price if you believe Mizuho. And you know how that psychology works. They just think it's too expensive, so they're going to gravitate to a stock that has a lower price, even though the valuation might be higher.
Exactly, and that's what investors say. This is all about the retail crowd. It doesn't change anything about the company's underlying value or fundamentals, but what you just said, a $200 per stock looks so much better to that retail investor than $1,000.
Yeah.
And I mean, Nvidia has a really good track record with retail investors. So far, they are ponying up to pay the price to buy into this AI rally.
Yeah.
Vanda research shows that it's one of the top bought or traded stocks for retail investors alongside Tesla, AMD, Supermicro Computer, lots of AI names in there. So it really remains to sort of see what Nvidia might do.
All right, Carmen, we're going to have to leave it there. We should point out, Nvidia is down today, still up about, 8% on the week, like something like 9 straight weeks of gains. Carmen Reinecke there. Keep an eye on Nvidia and all the chatter about a potential stock split. Alex, I want to draw your attention to something else real quick before we go to break. And this is actually NYSE. We've been talking a lot here about all the activist investors circling this company. The share is spiking right now, up about 4%. A report from Axios, Bloomberg hasn't confirmed this, but a report from Axios is saying that Macy's may actually directly negotiate with Arkhouse on that deal. Remember, they offered $21. They raised the price again. Axios now saying that might be enough to lure Macy's into a direct negotiation, even without a strategic review.
That is quite interesting.
Yeah.
At the same time, when we obviously saw them struggle, they're closing some stores, etc. More on that as we get that coming up. We'll take a look at industrials. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So here's something interesting. You're talking about the rally broadening out. Industrials are doing really well, and they're attracting a lot of inflows. I have this fun chart for you, Romaine. If you want to take a look, here we go. Industrial sector SPDR fund, which is ticker XLI, the ratio to SPY, right? And you can see the breakout, like the outperformance. Now you could say, whatever, that's mostly Uber, but it's not. Yes, Uber's a big part of that, but GE's done really well. Honeywell also has been holding up. Caterpillar doing really well. It's the real economy stocks.
Yeah, and even like those secondary names, not to diss them anything, but the Eatons of the world and Dycoms and everything like that. It's kind of been the stealth rally. I mean, I was looking at this the other day because I was trying to count up the number of stocks that were hitting either all-time highs or 52-week highs, and I was actually surprised how many of those names weren't tech names and weren't the traditional companies that we're always talking about every day.
Yeah, and investors are actually buying into it. I mean, there's levels that the flows that we've seen into that ETF, we haven't seen in about 3 years, like $17 billion so far.
If you believe we're getting a soft landing, you believe the Fed is going to be more accommodating, then yeah, why wouldn't you buy something that is much more closely aligned with the real economy?
So let's get to an analyst who does this for a living. Our next guest has two top picks in this space, Heiko and GE. Joining us now is Jefferies analyst Sheila Kahyaoglu. We will talk about Boeing, but maybe we'll do that at the end because usually you just come on and talk about Boeing. So do you agree? Like, do industrials have more room to run the real economy, like those names?
I'm going to talk about some winners today. One of my top picks is GE. The other one's Heiko. GE's up 75% since we initiated on it in April 23.
Wow.
We like it because of the aftermarket exposure. Both of them are 70% aftermarket exposure. What does that mean? If you can't get a plane, if a plane loses an engine, a wheel, then you got to call these guys for that repair part or for that.
It's services.
Exactly. It's a services razor blade model. GE just hosted its 2-day analyst day. Vernova, which is its power unit in aerospace yesterday, it's splitting on April 2nd. So big catalyst coming up. They announced a $15 billion buyback, capacity to do up to a $25 billion deal. So lots of catalysts still going with GE despite how high it's gone.
I was looking through their PowerPoint presentation on power, and I was really struck by that point, is it was a services part. Like, they're going to build the stuff, but the services is really what's going to help grow their revenue over the next few years.
Yeah, across their entire portfolio, whether it's Vernova or the aerospace business, which is 70% commercial services. Their military portfolio even has 55% military services. So that's really something Larry Culp has talked about, in addition to Flight Deck, which is his new productivity initiative that he launched last month. If you think he can't get better at manufacturing, he somehow found a way to push it forward one notch.
But they're still going to maintain that balance between the government contracts and the commercial aviation, right?
Yeah.
Because that was always a selling point for investors for years.
Yeah, the big focus is, though, their engine technology, their commercial engine business, whether it's the LEAP or the CFM56 that powers essentially all the narrow bodies around the world. Raytheon's its other big competitor, which essentially has only 25% of the market. So GE really dominates there, and their wide body share is not something to be, talked down. On the 787 last year, they won 99% of engine competitions. Pretty impressive against Rolls-Royce. So not only do they have a service story, one of the things in their analyst day that they talked about was margins essentially flat through 2028, their target. But I mean, if you have market share like that, you probably are raising prices.
All right, let's talk about one of the other picks, a smaller company, but one I think they actually probably have a bigger presence with when it comes to the military contracts, and that's Heiko.
Yeah, Heiko's a really unique little animal. It's it started by this family, the Mendelsons. It's about 65% commercial aftermarket. The remaining business is military widgets, and that's their ETG group. That hasn't been performing as well, but we really like it for its aftermarket franchise. And they tend to have a generic part. That generic part, they price about 40% below a name like General Electric or Raytheon would. And they service the midlife of an aircraft, and they do a good job of that. So we think that there's a lot of upside with their pricing because they've been two nice guys, these Mendelsons. They don't price as much when inflation was really booming, and they just bought their largest competitor, OneCore. So we think that there's a revenue synergy opportunity.
Oh, that's interesting. Why do you think they're not pricing as aggressively?
They're really nice people. They tend to price 40% below the competition.
That's a lot.
Yeah, and I think a lot of aerospace, given the delays we've seen in the supply chain, all the Boeing issues, right? If you need a part, the airlines will pay anything to get it serviced. So the OEs, rightfully so, have taken great advantage of that. And that's really what's driven GE's EPS revisions over the last 12 months.
Can we get to Boeing then? Because there was how many things happened? The wheel fell off on a United plane. There was a fire.
Minor fire on the engine.
Minor fire. And put that into perspective for us, because we can sit here and joke about it. We're glad no one was injured. We can joke about it and then be like, oh, Boeing. But these are issues that happen with planes a lot, right? So where's the distinction between Boeing's got real problems with yes, this is normal stuff that happens to planes?
Yeah, there's been a lot of Boeing news. The NTSB came out, said they weren't cooperating. Boeing has specifically said they did provide names and they're cooperating as much as they can. I do believe that they are providing as much detail as they can. Part of the issue is in their manufacturing process. Potentially they don't have the documentation, and that's what results in some of these back and forth. But the stock's at 200. They're going to report February orders and deliveries on Tuesday at 11 a.m. And we think they could come out with as low as 17 deliveries on the MAX. Keep in mind they should be at 38 today. We know they're not at 38 because the FAA is monitoring them, telling them to stop production. So all this, news flow doesn't help. And of course, the Spirit news last week, there's a deal that's probably imminent.
Yeah. Well, what do you make of that Spirit deal? I mean, do you think that would help them by having this back in-house, fully in-house? Does that help with quality control and some of these other issues? Or does this just maybe just add another burden, I guess, to what Calhoun's trying to do over there?
Yeah, I think, clearly Dave Calhoun 12 months ago or 9 months ago was not so keen on in-housing Spirit.
Yeah.
What they've done is put in a Boeing 30-year veteran to run Spirit. Mm-hmm. He's been there since October 3rd, and potentially he could turn it around. But clearly there's other factors in here, like the FAA asking Boeing to take it in-house. But it's probably not the best idea in our view, just because Boeing has to focus on its own production line, and whether it's not going to bring the Wichita work to Renton, it's still going to stay in Wichita.
It's still going to be separate. So this is kind of just be under the umbrella in name only, but not really.
Exactly.
Gotcha.
But one quick point on that. Don't they have to kind of buy Spirit? Like I know you said you'd rather them focus on their production line, but don't they have to? I mean, is there any other option?
Spirit could be a standalone entity.
Still?
Yeah, it's gone through the worst of things. It lost about $350 million of cash flow last year. It had a free cash flow outage. They refinanced their debt. They're actually at a turning point. They've diversified 20% of their business to Airbus. Now, the problem with them, aside from the Boeing factory issues that they've had, which is quality issues, is that their Airbus work is actually still losing $200 million of annual free cash flow. So they have to do something with that. So if Boeing does take them in-house, first of all, they're not going to buy the Airbus business. What price are they going to be able to sell it at? So the deal is messy, to say the least.
All right, Sheila, always informative here. And while Boeing may be having troubles, you definitely saw two interesting picks there on GE and HEICO. Sheila Kahyaoglu over at Jefferies. Closer look here at the industrial economy. Coming up after the break here, Bitcoin hitting $70,000 at one point for the first time ever. We're going to dig deeper into the crypto stocks moving on the back of that. That's coming up next. This is The Close on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
All right, let's take a look at Bitcoin. At one point today, trading above $70,000 for the first time ever. And despite pairing some of those gains after the milestone, crypto-related stocks still holding on to some really strong gains. With us now for our stock of the hour is Bloomberg's Abigail Doolittle. I mean, we're looking at 8% up on Marathon, 5% on Coinbase, and MicroStrategy, which is kind of like the OG in this space now, at least in terms of those folks who pivoted, a 9% run on the day.
It's incredible.
Yeah.
I mean, the animal spirits just don't stop here. It reminds me of other bubble type trading activity. That doesn't mean that we're near the peak, but I am reminded of the 7 or 8 stages of a bubble, so I actually wrote them down here. So mania, you have the takeoff, then you have the media attention, then you have the enthusiasm, and it's going like this during that. Then you go to the greed.
Okay.
Then you go to the delusion.
All right.
And then at the peak, it's the new paradigm. Now, are we at the new paradigm? Are we at greed, delusion? I don't know. But we're definitely not in the takeoff, and I would also say we're not in the denial or the fear.
Okay. Yeah, can you do the 7 stages of greed?
This feels like very like a philosophical way
I
of
learned
looking
something
at
today. I was like,
Bitcoin.
oh, okay. I didn't know there were 8 stages.
What about like so who is this good for? Like the investors, okay, who invest in it, the miners, like what groups work?
So, right now it's working for everybody because everybody wants in on it because they don't see the other side of that parabolic uptrend. Over the last, I would say from 50K, I mean, let's face it, or at least to me, I think that there's not strong fundamentals for Bitcoin and crypto, or at least not widely understood ones. You can say, well, the creation of the ETFs this year really
The halving?
What's that?
The halving.
The halving, yes, you're correct about that. So, but I would say that also goes into price. So this is a great marketplace to chart. It charts very, very well.
But this is, I mean, you are like an expert on like technicals and how that moves the market. And we know the fundamental story is a little bit tenuous here.
Yeah.
But you also understand supply demand. And we talk about the halving. We talk about these 10 spot Bitcoin ETFs that are trying to hoover up as much coins as they can get their hands on here. I mean, isn't that
So
enough?
that's all showing up in the chart. 'Cause
Okay.
the chart, like at the end of the day, you're just trying to see if the buyers or the sellers are in control.
Yeah.
And if you assume that the buyers are buying at the lowest price possible, sellers at the highest price, and all the information that we don't know comes in, that's sort of playing into that. Right now, since about 50K, maybe even 40K, it's parabolic. And a parabolic uptrend per physics cannot hold. It's a 90-degree angle. Now, there's at least one exception to that, Tesla. Tesla never, and in 2012 or 2014, that trend never really reversed. So right now we're in the mania stage, but it's interesting because over year to date, to your point, Alex, Marathon, it's down 20%. Riot is down a little bit. So the miners aren't up in the same way. You were mentioning MicroStrategy. I remember back in the day when it was a pure play software company.
Yeah.
Now I think of it as this almost principal trader, or you were saying hedge fund.
Yeah, it's a crypto hedge fund.
I mean, it's really sort of amazing. So over the last month, let's guess, in February, how much do you think that MicroStrategy was up?
50%.
104%. So if that's not a definition of a mania, tulip mania, bubble, I'm not sure what is. I'm glad to provide a little entertainment here, but I do think it's real. I mean, if you take a look, the last time we had parabolic uptrends in Bitcoin, it reverses each time. We don't know when. I mean, this could go to 80 and then reverse, but people want in until they suddenly want out.
All right, Abigail, thanks a lot. Really appreciate it. But interesting when you pair it with what Katie Kriske was saying is that there's allocation. Like everyone needs to have some allocation.
Yeah.
It doesn't mean you can trade it or you can kind of ride it out, but some allocation in your portfolio to sit.
But isn't that demand for allocation going to increase? And if that does increase, where's the supply?
I don't know.
Oh, okay.
Coming up, Diane Jaffe, Senior Portfolio Manager
Abigail, you're still
over at TCW, joins us with her top stock picks. As my daughter says, oh. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. And I got some bad news for you, Alex. I was keeping an eye on the S&P 500 to see if it was going to crank out another weekly gain. It was tenuous when we started the show, and as of right now, that weekly gain is no more.
Can't make it happen.
Yeah, sorry.
It's just going to roll over.
Yeah. Well, we still got 10 minutes.
But we knew this because yesterday, what was my opening line? Hey, I'm feeling better about the rally. So obviously today, everything was going to fall out of bed. So the S&P is down, as Romaine was saying, 6/10. You got the Nasdaq 100 also off. You have the Russell now in negative territory. I mean, pretty much flat. But I want to try on Tesla here because that's down 2%. And my broader question is, Romaine, if you have Tesla and Apple and Google, if they continue to kind of weigh and they can't find support, what does that do for the overall index? Now, it just then begs the question that other sectors, healthcare, industrials, financials, do they have to make up what Tesla and Apple and Google are dragging on the index?
And they might. And I'll steal a comment that one of our guests made earlier this week, said that, look, it might have been good for at least now, it might have been good that all those stocks sat out the rally earlier. Those 493 stocks sat out that rally that we had over the last year or so, because maybe that means they do, at least in aggregate, have the ability to sort of resurge and lift the market up, assuming Apple, Tesla, and the rest of the Magnificent Seven fail to do their job. Of course, the macro is still in focus. We got a jobs report this morning, mixed to be sure, but it did maybe offer some clues about the Fed's rate path. Julia Coronado stopped by the program earlier. Take a listen to what she had to say.
Our own forecast is for 125, so steady pace starting in June of 25 basis points a meeting, partly because we do expect after we get through this kind of beginning of the year noise that inflation will do what it did last year and drop down to a new range and really outperform the Fed's expectations.
Joining us right now is Diane Jaffe, Senior Portfolio Manager at TCW, to help us count down to the closing bell. And Diane, I am curious. I mean, are we still in that focus right now where rate cuts, and more importantly, where rates end up, are still going to be the primary determinant of where the equity market goes?
I'd like to see that fiscal policy still has some legs to go. We have a lot of new monies coming into the investments and capital investments throughout the economy. I think that's important. I don't know if we really need all the rate cuts that some people were hoping for.
It's interesting to see some of the rotation we've seen in this market away from the Magnificent Seven and into all those names that everybody seemed to have forgotten, or at least some folks had forgotten here. You've seen a pretty big rally in those names. And we were talking yesterday about the S&P Equal Weight Index finally hitting a high after 500 plus days of lagging the broader market.
We track all the sectors every day because what we really want to see is more breadth, and we have been seeing that. It has not been just comm services and IT. We are now seeing financials participate. We see consumer discretionary, industrials you were talking about earlier. I think that is going to be part and parcel with a growing economy, and when many people were worried about recession.
So what do you like right now? What's in the top picks?
So one of our top picks is newsworthy today, which is Broadcom, right? They reported last night, and even though it was pretty good, the concern was maybe some of the telecom spending was dampening down their extraordinary AI ramp.
And does that mean that you don't like Nvidia, or does that just mean this is a better value way to play?
It's a better value way to play. We love Nvidia, but it is too expensive for us. It's really in the hands of your growth portfolio managers and clients.
I was looking at some of the other top 10 picks. There weren't a lot of sort of high value tech names on there. I look at industrial companies, healthcare companies, and even media companies in there.
Yes, Comcast for sure, JP Morgan, GE, you were talking about earlier. They, Lennar in the consumer discretionary space, I mean, that's really been a pretty nice tech stock.
And you think something like Lennar? And you think that has more juice in it? I mean, because that's had a pretty good run too.
It has, and it's still trading really attractively on price to book. They're asset light. They're going to be reporting next week, so of course we will be waiting to hear what they have to say. But the first-time home buyers is still super strong.
Let me ask a question. If we get a 100 basis point cut from the Fed this year, so we get, say, 4 cuts, what do these companies do you think? Do they invest a lot more? Do you get the sense that there's a lot of pent-up demand? Or is it just steady as she goes for these guys?
So I think that it will lower the cost of capital for people. It will really help mortgage rates. I think that's if you think about the multiplier effect for every new home purchased, it's literally 2 to 4 times. So that is another spur to the economy, and lower mortgage rates will definitely be a positive for new home buyers.
For the overall market, do you think that 4 cuts spurs a bigger rally? Does that bring us into bubble territory? Or do you think that it's more of a rotation within the market?
I would accept more of a rotation, right? I think you have Nvidia and it's grown 400% or whatever over the last couple of years. Some people are taking profits, including some insiders. We've seen it. Meta and other big high-flying comm services or IT names have been taking profits.
So when you look at sort of overall allocation, portfolio allocation, are we at a sort of inflection point where people need to start thinking about rejiggering that in some meaningful way? Or is this kind of a stay the course until we get a little bit more clarity?
Well, one of the things that we really focus in on for us and our clients is that we're always going to be diversified across all 11 major economic sectors. We think that's really important for the long run, although you can get these spurts in different sectors like IT or comm services that really, rally everyone's enthusiasm and attention. But we think that once investors started feeling better about the shape of the economy, that's when we started seeing the breadth happen. And so I would like to have your viewers say, you know what, maybe there's some other places that I can invest and get a good return today.
You need to have some confidence, though, in economic conditions, or at least where you think they're going, right?
That's right, and the consumer sentiment numbers are pretty good. The macro is definitely seeping in after we had a fantastic fourth quarter earnings season. So there's usually that lull between companies reporting and the next earnings season, and that's when the macro comes in. So please expect a little bit of some volatility here.
Just to end, you have JP Morgan on your list, you mentioned it. Do you not like the regionals at all? Is it just bigger is better when it comes to the big banks?
It's so interesting.
She literally made a face like she was going to throw up. Let's just put it that
way. Historically, regionals have outperformed and had higher valuations, but there's just so much uncertainty about what's on their balance sheet, and of course, we've seen companies have to write them down. So, universal banks really have been a safer place to be.
All right, Diane, always wonderful to talk to you. Diane Jaffe, Senior Portfolio Manager over at TCW, helping us count down to those closing bells. We're about 3 minutes until we get to those bells, Alex. Seeing stocks right now around session lows, erasing pretty much all the gains for the day, and it looks like for most of the major indices, erasing all of the gains for the week.
Yep. I'm still really interested in sort of what do we look at after this?
Yeah.
Like, do we just look at price action until we get more economic data? I mean, we got all the juicier stuff. Earnings are done.
Well, I mean, you still got the big Fed meeting in a week and a half's time. And then from there, I think it is going to be a kind of a technical-driven market.
Yeah.
Maybe till you get back to the next earnings cycle. I do want to point out, and this is just for you, Alex, I did see the latest CFTC data coming in. What the hottest trade out there right now is gold.
Really?
Yeah.
The most longs in gold?
The biggest weekly increase, we should say, in net longs going back to mid-2019. So people are
interesting.
waking up to that here. I mean, I know you and Tom Keene have had that under the mattress trade going for like 50
Under
years
the bed,
now.
under the bed. I mean, the mattress
All right,
is
stick
too
with
uncomfortable.
us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Seal. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast. Scarlett Fu stepping into the television studio. Carol Masser and Tim Stenovic just starting their day in the radio booth. Welcome to our audiences across all of our Bloomberg platforms.
Under the mattress?
And
what
I cannot hear myself speak
there?
above the din of Carol Masser. Happy Friday, Carol.
This is what it's like to be a woman in our world today.
Happy International Women's Day, Carol Masser.
Happy to you as well. Interesting day, different tone. It's been a busy, jam-packed week with a lot of stuff going on. And of course, that big monthly jobs report that once again, I was talking to Mike McKee in the newsroom. I'm like, Goldilocks economy, can we say soft landing? And he's like, maybe Goldilocks. But what's happening is we continue to get data points, right, where there's kind of a mixed bag of data, and it can be somewhat confusing when it comes to investors trying to figure out what happens next.
Yeah, I mean, look no further than what we saw in the equity markets today. We saw new highs on the S&P 500 and the NASDAQ 100, only to see reversals late morning when it came to chips. And now it looks like we're going to see these equity averages move lower on the day today. Bitcoin's an interesting one. I can't explain it, but it hit a new record. It hit a record today, I should say. Still above $69,000 per Bitcoin. Scarlett.
Yeah, it got to 70,000, but it failed to hold at that level. And it was right around that time that it and the NASDAQ 100 both reversed course and turned lower. So maybe the fact that that 70,000 level was just, a blip meant that people were saying, oh, you know what? Heading into the weekend, we don't need to be testing this level again.
You know what we haven't talked about? Cruise stocks. Did you know Carnival, second best performing stock within the S&P, Royal Caribbean also doing well too? It's like, you're going to take cruises? How bad can the economy be? Like, you're still spending a lot of money on that. Those things are expensive.
Isn't that like recession proof though? I feel like the cruise lines.
They probably want you to think that.
Yeah, all right. Well, there you go. I mean, if it's any consolation here, I mean, only in sectors right now that really performed, at least on a daily basis. You're going to find that in real estate, energy, and utilities. The net effect of it all is red across the screen on the day and on the week. A Dow Jones Industrial Average down about 68 points or 0.2%. The S&P down about 34 points or 0.7%, while the NASDAQ Composite sold off by about 1.2% here on the day. The NASDAQ 100 down 1.5%. And the Russell 2000, that was your relative outperformer, though still in the red, down 0.1%.
I'm glad you brought up Carnival. Stifel seeing 2024 guide boost on strong demand. So basically, they looked at healthy booking patterns. So apparently, Alex, I guess people are taking cruises and they're booking way out. So some optimism there. But the stocks, I'm just going to flip around. The stock's coming under a lot of pressure, so that's not where we saw investors moving into. Maybe moving into cruise line stocks, but not into semiconductors. We know Broadcom and Marvell both coming out late last night, and that certainly has put some pressure on the trade. The stock's down about 4% today.
Yeah, that was a 1-2 punch for the tech sector as a whole, because if you look at the 11 industry groups in the S&P 500, the biggest slice of the pie belongs to infotech and semiconductor stocks, leading the way down there. The group falling 1.8% as a whole. Consumer staples down about 0.8%. Materials also under pressure. There were 4 sectors in the green, led by real estate investment trusts, energy stocks, and utilities.
All right, guys, let's get to some of the individual gainers in today's session. They kind of flipped from this morning to later in the trade as the markets moved down here. So having said that, Carvana, though, staying atop that list, but way off its highs of the days. At its highs up almost 14%, finishing the day with a gain of about 7%. RBC out, issuing an upgrade to sector perform. They doubled the price target on the name to a street high of $90 a share. Stock, about 32% of the float is shorted, so just keep that in mind. That's kind of interesting. Stock still has had quite a run up, more than 60% year to date. RBC saying the stock has the potential to trade even higher, and an underperform rating is infeasible for the foreseeable future. Another one, Biogen. It was among the top gainers in both the S&P 500 and the NASDAQ 100 after Eli Lilly said the FDA is delaying its decision on its Alzheimer's disease drug. So that meant for Biogen, which makes a different drug, its own Alzheimer's drug, that received FDA approval to treat Alzheimer's in July, or starting in July, I should say. So Biogen was up about 4% at its highs, finishing the day with a gain of about 1.8%. And one more, it was a pandemic darling DocuSign, up 10% at its highs today, finishing the day just under 5% gain here at the close. The company coming out reported fourth quarter results, beat expectations. It also gave an outlook that is seen as strong. We talked about that one late last night. So again, some of the outperformers in today's session, Tim.
Okay, there were no shortage of underperformers. It's actually hard for me to choose just four, and I did choose four today. I do want to actually hit an extra one. Broadcom closing down 7% in its biggest drop since March of 2020. We did see a reversal in the chip space today. In the late morning, Nvidia had hit a record before falling as much as 6% to finish the day down by 5.6%. In a sign of how far Nvidia has rallied just this year, at one point in the day, a relatively small drop erased more than $140 billion in market value, which ranks among the biggest single-day value destructions in U.S. stock market history. So that's how far Nvidia has come in such a short time. I do want to check in on shares of Costco. They did finish lower on the day today by 7.5%. It's the biggest intraday decline since May of 2022. The company reported second quarter revenue and gross margin that did not meet consensus estimates. And then Marvell Technology, another one in the chip space, fell as much as 11% earlier in the session, but ended up finishing the day finishing down 11.36%. The company did give a first quarter forecast that was weaker than expected. Analysts said that AI was unable to offset weakness in other parts of the business. And an honorable mention is Amylyx Pharmaceuticals. This company just plummeted today after its drug for ALS failed to benefit patients in a trial. It suggests that U.S. regulators may have approved an ineffective treatment. Look at this, guys. Shares finishing the day down by 82%. Remember, this is a $160,000 a year treatment for ALS, and it gained full FDA approval back in 2022, despite uncertainty around it.
That chart kind of doesn't do it justice,
it really
right?
No,
I mean,
it's been down there all day.
It's basically like draw a line on the bottom.
Yeah.
Just look at the top right. Just look at the top right corner, that big number in red. That's all you need to know.
There is something in there. All right, guys, looking at yields. Honestly, a bit of a snooze fest. The action more in the front end. You saw a lot of buying coming in when that jobs number came out. You had yields down by a few more basis points, but ending the day down 2. I mean, that's not where the action was.
All right, you know where the action is headed, guys?
Tell me.
Miami Beach.
But they don't want it to be there. That's the thing, right?
Well,
I feel like they want you to go somewhere else.
Actually, right. It's been there. And there's a big warning. There's a great story. It's among the most read on the Bloomberg. And basically, Miami Beach has a pretty stern warning. And they are spending about $250,000 to basically warn any of those who want to come down there for spring break. They're also going to be drunk driving checkpoints, a 6 p.m. curfew on the beach. 6 p.m.?
Hey.
6 p.m. Isn't that when it starts?
That's fine with me.
It's like Boca.
That's bedtime.
Boca. No access to city garages or sidewalk seating on the famed Ocean Drive. This is what happens when you have a lot of wealthy and influential individuals that are moving down, and so they're trying to kind of portray the area, Miami Beach, to be a little bit more sophisticated.
Yeah, billionaires like Ken Griffin, Josh Harris, Orlando Bravo, they all now own luxury homes there. You know, they're trying to rebrand Miami as Wall Street South. So, you know, it's a different demographic.
Did they actually go down to South Beach? I thought they just stayed sequestered over there.
I don't know.
Well, now they can because there's a curfew for the party people.
It's okay. If you still want to party, you can go to South Padre Island, okay? Because South Padre Island in Texas has spent $400,000 marketing itself to spring breakers, college students, and families, although I don't know why families would want to go if spring breakers and college students are there. There are about 2,000 permanent residents there, and they're overtaken each spring break by 1.7 million visitors.
There's a battle of the universities, apparently, and they feature a giant Jenga tug of war and limbo contests.
I think I know where you want to go for spring break.
Terrible, you guys.
I think if you live there, you know where you don't want to be and where you want to go, somewhere else you want to go. On Sunday, of course, we have the switch to daylight savings, but we also have the big Oscar telecast. And my favorite part of it, it's like the Super Bowl for celebrity news and entertainment, is to watch the red carpet. And one of the big things, Alex, that they're talking about right now is sustainability in fashion, and how that could really, the starting point could really be in shoes and footwear.
So apparently this is the second year that the Academy has given attendees a guide to dressing sustainably for a more eco-friendly look, which I find kind of interesting. And Laura Williams, who writes for Bloomberg Opinion, was saying, if you watch the shoes, like that's where the trends will start to appear. And I will, because I watch Romaine's shoes every day, and I swear this guy has a different pair every single day. So this, I'm already like trained. I'm already trained to watch the shoes. Is it true?
Joke's on you, Alex. I'm not wearing any shoes.
He is. Very nice brown shoes.
So does that mean Lady Gaga's going to pull out her meat dress again? Like as long as it's sustainably, no hormones and all that good stuff?
Is it sustainable?
I don't know.
That was before sustainability fashion really.
I think we're
became
talking
a
more
thing.
like eco-sustainability.
Oh, okay.
Like
More people.
Okay, so no meat dress.
I'm one of those people. More people watch the State of the Union than watch the Oscars.
Oh, we had a chart on this, Tim.
Yeah.
We're way past that. Yeah,
okay. Well, I'm one of those people. I can tell you that I watched it last night, and I don't think I'll be watching
Does
Sunday
Romaine
night.
really not have shoes on? I'm really sorry.
What color are his
You'll never
socks?
know, Carol.
That's a question.
All right. To be continued, apparently. All right, guys, that's a wrap. Have a great weekend. Our cross-platform radio, TV, YouTube, Bloomberg Originals, Beyond the Bell. We will see you again on Monday.
And we continue our coverage right here on Bloomberg Television. Stick with us. A lot more coming up here, including a conversation with Veronica Willis over at Wells Fargo and a breakdown of the latest Women and Investing report. This on International Women's Day. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu with Romaine Bostick. Stocks backing off record highs, finishing the week on a down note, even after a Goldilocks jobs report that basically puts the Fed on track to cut rates later this year, as Jay Powell had told us earlier this week. We had some buying at the short end of the yield curve, so the 2-year goes down by 2 basis points to 4.47%. This, of course, before the big CPI data next week, which will be one of the last data points before the Fed meets the following week. And we're keeping an eye on Bitcoin, of course. It did touch 70,000 before backing off, but still higher on the day right now by 2.8%. And I just want to mention what's going on in Brazil. The iShares Brazil ETF falling more than 2% after the state oil giant Petrobras announced a smaller than expected dividend as it invests in a green energy transition. That's renewing concerns that the government will continue to maybe interfere with the big companies and how they move forward. Now, in terms of individual movers, a lot of down stocks here. Marvell Technology, along with Broadcom, some of the big losers in the semiconductor space after their latest earnings disappointed investors. Eli Lilly losing more than 2% on the day, and this after its Alzheimer's drug faces further delay from U.S. regulators for approval. Costco was the worst performer in the S&P 500, losing more than 7.5%. Quarterly results were fine, but analysts say they don't see much of a catalyst for further gains ahead, given where it's valued, given its multiple. And with the exception of a couple big tech names, I feel like that same idea could apply to much of the U.S. stock market. We do have Apple rising 1%, and although that's not a big move by any stretch of the imagination, it was the first gain in 8 days. So it snapped a 7-day losing streak. There's no particular news that drove the stock higher, but Apple did submit to European pressure and will now allow Epic Games, which is the operator of Fortnite, the maker of Fortnite, to offer its own iPhone app over in Europe. Romaine?
All right, it's International Women's Day, and there's a new survey out from Wells Fargo, and it highlights the gap of investor confidence between the genders. And with the stock market reaching new highs, there is a higher risk associated with not being invested in the market. Veronica Willis is joining us right now. She's a global investment strategist over at Wells Fargo and was part of this report here. And Veronica, we've been talking for years here about kind of this differences that we see in genders, the idea that men, rightly or wrongly, tend to have a lot more confidence in making investment decisions. Women tend to be maybe a little bit more thoughtful, and maybe that holds them back from pulling the trigger here. Have you seen a material change in that gap between the way we approach and look at investments?
I think what's interesting and what we've observed, over the past few years of doing this research is that women are reporting a little bit more confidence in the stock market than they used to have. So they're closing that gap between the confidence that men have reported in the stock market for their investments. And it's crucially important for women investors because many studies have reported that women tend to have lower retirement savings when it's time to retire than their male counterparts. And with women living longer, they might need more assets than their male counterparts when it comes to retirement. And so it's really crucial to have that confidence in the stock market because that's going to be a major driver for your growth.
Well, even with that trend on confidence or disparity, I should say, what does the data show when it comes to the actual results, the returns that men get versus what women get? Is there a material difference there as well?
Yeah, so what's really interesting, even with reported less confidence that women say they have on a risk-adjusted terms, they actually achieve higher returns. So we looked at various different account segments, and female-led joint accounts actually have the highest risk-adjusted returns out of, male-led joint accounts, single female and single male accounts. So they're being smart about the risk they're taking, but not letting it hold them back when it comes to that return.
So when it comes to allocating their assets and deciding how much risk to take on, what are you observing in terms of female investors? Are they seeking out investment professionals to help them do just that? Or are they taking up a lot of the model portfolios that some firms, and I'm thinking BlackRock here, have created for women to account for their longer life expectancy, their interrupted time in the workforce, and their lower relative income to men?
What we found is that women are actually more likely to seek the guidance from an investment professional to really build out that investment plan. And they're really great at sticking to that plan. And that's something that's really crucial for the success over the long term. You don't want to deviate from the plan when there's a lot of market volatility and a lot of uncertainty. It's key to stay invested in the market so you can really observe and get that growth.
What about for women who are investing when they're younger, they're at the early stage of their careers? How do you think about the weighting of growth assets, of risk taking for that kind of investor? In other words, should a young woman who's starting to invest be really aggressive and perhaps double down on an Nvidia or even Bitcoin?
Yeah, I think when you're younger and you've got more time to recoup losses, that's the time to take more risk. As you get closer to retirement, that's when you want to start pulling back on the risk. You don't want to start off under risked. And so being early in your career, you've got many years until retirement. That's the time to really take those risks. You don't want to over risk yourself. Be smart about those risks that you're taking, but that's the time to really capitalize on the growth. You've got the benefit of compounding the more years that you've got until you need that retirement savings.
Well said. Thank you so much. Wells Fargo Global Investment Strategist Veronica Willis. And even with the benefits of compounding, a lot of women, according to Veronica's and Wells Fargo's research, shows that they tend to be much more conservative, holding a lot more of their assets in cash. And you can compound cash, but it's not going to get you anywhere. Investing in equities or anything more risky would get you.
Yeah, and you're probably not going to compound as fast as inflation, at least certainly historically. But it does get to this idea too, because if you look at the report, I was intrigued by the fact that on a risk-adjusted basis, actually some women are actually doing better in terms of the actual percent returns that they end up making. So maybe it shows that maybe a little bit slower and steady approach might be a little bit better than, I guess, the rash approach that is stereotypically applied to men.
Right. The research shows that women trade less frequently, so perhaps they set an investment plan and then just leave it as opposed to going back and adjusting it and tweaking it and making some changes and adding some options when Nvidia keeps surging higher.
Yeah.
All right, coming up, we're going to talk to Morningstar's Christine Benz about what higher rates mean for your retirement income. So we're going to continue this conversation. This is The Close on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
All right, welcome back. That record run that we've had in equity indexes. You couple that with substantially higher interest rates, yields. That should be a recipe for strong retirement funds for senior citizens here in America. Let's discuss right now with Christine Benz. She's Morningstar's Director of Personal Finance and Retirement Planning. And Christine, I do want to start off with this elevation that we have in interest rates. I know if you believe the market, they're not going to go any higher, but they've been elevated for a while. And a lot of people saw that as something negative. From a retirement account perspective, though, when you look at a 5.5 Fed's funds rate and whatever that translates into in market rates here, is there still opportunity there for those folks out there who at or near retirement age to lock in some modicum of gains?
Absolutely. It's mostly a positive, actually. You know, we had that dislocation in bond prices in 2022. Stocks fell simultaneously. Obviously not a comfortable environment, especially for people embarking on retirement. But when you look at the higher safe yields on offer, it just makes everything about creating a retirement portfolio easier. You can earn a safe rate of return, not saying that you need to park your whole portfolio in fixed income securities, but a decent share of that portfolio should probably go toward fixed income securities, given that today's yields are so high. And that portends fairly good returns from the asset class over the next decade, at least.
And I'm sure, as you know, I mean, people of a certain age do tend to gravitate to annuities. There's obviously a lot attractive about that. There are some drawbacks as well. If you are able to lock in a pretty decent rate for an annuity right now, do you run the risk of having that, I guess, eaten up by inflation, assuming the Fed isn't able to sort of complete that mission?
That's the big risk with annuities. There's a lot to like about a product that will pay you a stream of income for the rest of your life, which is what you get with a very basic annuity product, and yields are higher. So it's certainly a lot better time to consider an annuity purchase than it would have been in, say, 2021. But the risk that you mentioned, Romaine, is exactly the one that should be top of mind for anyone who's purchasing an annuity, in that you do not get inflation protection. You can buy it, you can buy a rider that will give you some inflation protection, but right now there aren't any annuities that are linked directly to CPI. So if we have another year like 2021 with very high inflation, the annuity will not necessarily make you whole, or it won't make you whole in terms of your payout. So you need to weigh that carefully. The other thing you need to be really careful about is insurance company solvency.
Yes.
So you want to make sure you're with a really good company.
Christine, I also want to ask you about Social Security. Speaking of solvency, I'm a Gen Xer, so I grew up thinking that Social Security was going to be insolvent by the time I was able to tap it. Is that overblown thinking on my part? Are we going to be good for it?
Well, it's hard to say that any one cohort is absolutely going to get their promised benefits. Certainly people in the baby boomer generation, just approaching retirement, I think they can fairly safely assume that the benefits Social Security is saying they will pay out will indeed pay out. For younger generations, millennials and below, for example, I would probably, to be safe, haircut my promised benefits a little bit. I think it's certainly extremist to suggest that Social Security will go away, but there may be some changes. In fact, there will likely have to be some changes to starting benefits dates, to potentially income that is income level. Maybe there be some means testing. There may be some incremental changes to the program.
Okay, so they should brace themselves for those kinds of adjustments. For those Gen Xers who are lucky enough to perhaps be retiring sooner rather than later, talk to us about the decision-making process behind whether you delay in filing for Social Security benefits or whether you just move forward with it, given the interest rate environment right now.
Right. So if you delay past your full retirement age, which is kind of a sliding scale, but it's roughly 67 right now, you can delay up until age 70, and you can get a pretty nice boost to your eventual benefits if you delay. So there is a strong benefit to delaying, especially for people who think that they have longer than average life expectancy. They'll probably benefit by delaying. It's a super good strategy to think about. One factor in the mix, though, is for people who plan to potentially file a little bit earlier and invest the money, well, the good news is that with higher yields that we have today, that's, potentially something where you could out earn your increase in your Social Security benefit by investing in, say, Treasury inflation protected securities.
These are all pretty safe types of investments, at least traditionally, Christine. I'm sure, as you know, there are a lot of people, they're looking at the rally in stocks, they're looking in the rally in, say, something like Bitcoin or some of the more speculative assets, and they are starting to wonder, I don't know, is it smart just to take 4, 5, 6% in the fixed income space when you could be chasing double-digit gains in some of these speculative assets? How do you address that?
I think balance is the answer. It's really hard to pry older adults' hands off their equity portfolios. They've had such a good run in stocks over the past 15 years. So the main idea is that you want balance. You want some safer assets, especially for your near-term spending needs. If you're getting close to or in retirement, you don't want to be in stocks for those near-term spending needs. But for your money, for years 10 and 11 and beyond of retirement, you absolutely do want those funds in stocks because you need the long-run growth potential that you will not get with fixed income securities.
All right. Always great insights. Christine, love to talk to you. Christine Benz, Director of Personal Finance at Morningstar. A closer look here at those folks near retirement age and some of the options that they have out there for themselves. Scarlett, are you going to delay your Social Security?
Yeah.
I know you're not 70, but...
as long as I can, right? Why not?
Yeah, well, according to her, apparently that's what we should be doing.
Yeah, and then in the meantime, I'm going to buy some Bitcoin at 70,000.
All right, when we return, a look back on this day in history and the birth, Scarlett Fu, of the New York Stock Exchange, at least as we know it today. And we'll leave you with a question before we go to break. What is the average daily volume for all of the NYSE listed shares traded?
I thought you were going to ask a question about buttonwood trees.
The answer when we come back. This is Bloomberg. All right, let's go back in history. On this day, back in 1817, the big board, the NYSE, was formally established. It was the culmination of almost 2 centuries of informal trading that traced back all the way to the 1600s and all the way to 1792 and that fabled Buttonwood Agreement, named for that fabled tree on Wall Street where stock trading was said to have taken place. Now, that agreement did set commission rates for securities sales, most of which at the time were just government issues, such as war bonds. But by 1817, the Industrial Revolution had spawned dozens of major corporations, each with capital-intensive businesses, which led to a boom in stock listings and a groundswell in trading volume, so much so that the NYSE chose to formalize its existence with a constitution and the establishment of so-called exchange seats at a rented space out there at 40 Wall Street in Manhattan. That was this day in history. The Constitution for this New York Stock and Exchange Board, as it was called at the time, laid out the rules for doing business. Stocks would trade just twice a day, once in the morning and once again in the afternoon. A list of 30 stocks and bonds were made available, and the president of the exchange would call out the name of each security one by one, and then the brokers would have to shout out their bids and offers. That was it. By the end of 1886, though, more than 300 different stocks and bonds were being traded, with total daily volume topping 1 million shares. That was a gargantuan number at the time that forced the exchange to shift away from single stock auctions to simultaneous and continuous trading, what we have today. And it was a session that started at 10 a.m. and ended around 2 p.m.-ish, Monday through Saturday. The introduction of the telegraph, then the stock ticker, then the telephone in the late 1800s expanded the NYSE's reach and dominance of financial market trading. The NYSE would also outgrow several locations before settling into its current headquarters, fronted at 11 Wall Street. By the early 1990s, average volume passed 200 million shares a day, and today it averages just under 1 billion shares. Saturday trading was jettisoned in the 1950s, and in 1985, the exchange established the trading hours that we now know best, 9:30 a.m. until 4 p.m., Saturday trading not included. There are a lot of questions right now about sort of where the NYSE goes next. It has gone through several iterations of ownership and 2 decades of technological and regulatory changes that have really spread equity transactions across more than 50 markets instead of really just being concentrated in a half dozen or so liquidity pools of years past. But the NYSE still holds a special and symbolic place for the financial industry, and it does remain the largest exchange in the world by market capitalization of the companies it lists.
And the first stop for many companies that want to list as well. I remember when there was a talk of making sure there was 24-hour trading. What would we call our show then if there was 24-hour trading? Because you can't call it the close.
Never close.
It never closes, exactly. All right, let's switch gears here because as many working parents know, the cost of childcare has climbed to record highs in recent years. And in response, we're now seeing more than half of U.S. employers starting to prioritize benefits that help their staff juggle and pay for the demands of family and work. Let's bring in now Bloomberg Equality reporter Kelsey Butler. Kelsey, there was a survey from Care.com looking at benefits beyond the traditional health benefits like health insurance, retirement plans, paid sick leave, and paid vacation days. What did it find?
So I thought it was really interesting. Child care benefits topped the list. It was above things like commuter benefits or food benefits, some of these perks that we tend to hear a lot about and be a little bit jealous of when it's at somebody else's employer.
But at the same time, companies are making adjustments to other things that they used to offer as well. You cite in your story about how Google and General Mills used to have on-site daycare centers for their employees. They're removing some of those benefits, those perks.
Yeah, and in those instances, those were kind of situational. So it's not everyone that's moving in this direction, but we're certainly seeing a wholesale kind of shift from employers. I thought it was interesting. The Care.com CEO told me that companies are realizing, okay, we're requiring people to be in the office more, but we have to give too a little bit, meet our employees in the middle.
It's interesting. I mean, childcare and family issues are at the top of the list here, but there were some other issues that were still pretty close to the top of that list as well that seemed to have to do with, I guess, people's own personal health.
Yeah, absolutely. Mental health support was close to the top of the list. And I think it's just kind of emblematic of this thing that we're seeing where people are bringing a lot more of themselves to work. And not only that, but being more vocal in what they need. I don't think that pre-pandemic people were maybe pestering HR quite as much about, we want this, we want that.
Also, thank you, millennials, and thank you, Gen Z.
You're welcome.
Thank you, Gen X, too, Scarlett.
Gen X didn't do anything, Romaine.
Gen X.
Gen X sat back and took it.
Oh.
We're like, oh, you want us to do this? Okay. That's what Gen X did.
Yeah. I know. This is a Gen Xer. We're both Gen Xers, by the way. But she's from a different breed. I don't know what's going on with her.
I'm just telling it like it is. All right, Kelsey Butler, thank you so much. Really fascinating article. And of course, check out Kelsey's work on Bloomberg.com. We want to dig deeper into the economics of caregiving and its ramifications, including what it means for the gender pay gap. Let's bring in now Emily Oster. She is professor of economics at Brown University, as well as CEO of Parent Data, which is a data-driven guide to pregnancy and parenting. Emily, it is so good to speak with you. Thanks for joining us today.
Thanks so much for having me.
So we're talking about child care benefits, and it seems like for now, some companies are prioritizing benefits tied to that. Do you worry that this will prove to be kind of a trendy management technique or a fad in the way that DEI seems to be, rather than a core benefit?
I think it depends how much people will end up demanding this. I think we have seen with other innovations in this direction, like better parental leave, 4 months or 6 months, including both parents, that has stayed. So some of this feels like if people use it and it becomes a way to attract good employees and keep good employees, then it will stay.
Right. At the same time, though, we're seeing companies be more vocal about demanding that employees return to the office 5 days a week, removing some of that hybrid work or that flex work that they had allowed during the pandemic and in the aftermath of the pandemic. But parents are having a hard time finding childcare, and they rely on that kind of hybrid work environment in order to take care of their kids at home and drive them to their parents' house and work at the same time. How do you see this playing out given where the economy is headed?
I think it's actually quite an unfortunate move in some ways, because one of the things we've seen in the last couple of years is a historically high participation rate in the labor force for women with kids under 5, particularly women with a college degree. And it suggests that some of that flexibility that's provided by hybrid work is actually benefiting women, and by extension, the companies who are able to then employ a better workforce because they're more flexible. We know that women demand more flexibility in their workplace, but that's different from saying that they want to work less. Some of what's given by hybrid work is the ability to move your work around in time to facilitate having young kids, particularly in this difficult childcare environment. So I think it remains to be seen, but this feels hard to me and like potentially a step backwards.
Well, I'm curious about the data behind this, Emily, because we've seen so much of the data that shows how this is beneficial to the women, the working women and their families overall. Does that same data also show the benefit to the companies? And if so, how widely shared has that data been?
So I think we don't have a lot of amazing data following this, unfortunately, and we don't actually have a good sense of even questions like, is the best thing for companies 3 days in the office with everybody and 2 days, 2 days of flex time, or 4 and 1, or whatever complicated system you could come up with. The other thing is some of these benefits are long term. So I think when I talk to employers about this, I will often tell them, hey, people's kids are not going to be between the ages of 0 and 5 for any longer than 5 years. And so if you keep someone and keep developing them there, then when they're ready to lean back in, then you still have them, as opposed to training a new person. And I think taking that long view is something that employers would really benefit from.
How do you get them to take that long view? We know a lot of companies, particularly those in the public space, are kind of have this albatross of short-termism around them, primarily because of the pressures investors put on them. So it's a lot easier to look at those folks working from home or have that flex time and look at them more as a liability than an asset. How do you get them to look at that long term?
I think that's really hard. I think all we can do is try to show the productivity that can happen when people stay in the workforce. And I think the other piece of it is recognizing that we talk so much about women here, but actually men also have children and also demand time with their children. And the more that we can make this an issue of giving people the flexibility to have the other parts of their lives and still contribute productively at work, rather than some kind of, work is from 8 to 6 and you must be there all of those hours and that is the only way to structure a workday.
Yeah.
That's not serving anybody.
I love that. Men also have children, something that employers would do well to remember. I remember, Emily, my accountant mentioning to me that I should pay our nanny on the books because, one, it's the right thing to do, and two, in case I decide to run for public office one day. Now, I'm not going to do the latter, but it's interesting because, as you know, in 1993, Attorney General nominee Zoe Baird withdrew her nomination as Attorney General because she had disclosed that she paid back taxes and penalties when she hired undocumented workers to care for her kids, and there was a ton of pushback from Republicans. Is this still a thing, or has this become kind of a don't ask, don't tell kind of situation?
I mean, I think that when we look at the options for childcare, people are doing a wide variety of things, and there is a lot of informal childcare, and whether that is childcare off the books, paid, whether it's family members, whether it's people getting together in small groups, whether it's an aunt or the neighbor down the street. Part of what happens in a childcare desert that many people live in is that they are doing a lot of different things, some of which are, hire a nanny on the books and pay taxes, but a lot of which are something else.
Yeah, I mean, it goes to the idea that paying for childcare is often so expensive if you want to do it the right way that for many working moms, it's cheaper, or it's more economical, I should say, to just quit your job and stay at home, watch your kids, rather than accept a salary and pay 90% of that salary to childcare.
Yeah, so I think that logic comes up a lot, but the thing I'd push back on a little bit there is that's a short-termism argument, like the firm argument, because those years, again, they're going to end, and eventually kids will be in school, and those lost years in the labor force are lost retirement savings, they're lost future earnings in terms of raises. So even if you thought more or less 100% of your after-tax income was going to go to childcare, it's not obvious if you're taking a longer view that that's a mistake, if what you want to do is be at work, which of course is another important part of all of this.
Absolutely. Emily, really important discussion here. Thank you so much for joining us. Emily Oster is professor of economics at Brown University and CEO of Parent Data. And of course, Romain, that idea, you remember Zoe Baird and the confusion and the controversy that caused.
Yeah, we're both Gen X, so we all remember that.
Yeah. I mean, can you imagine if male nominees' histories were vetted in the same way?
That's Congress laughing at you.
Yeah.
No, but I mean, you make a great point. I mean, look, we know there's a double standard. It's been a double standard for a while. It's gotten better. But as you were kind of joking with Emily there, when she said, men have children too.
Yeah, I love that.
But it's a great point, right? I mean, and sadly, it's a point though she has to make, because sometimes things like this don't get done unless you, how should we put this, convince the dominant group that this matters to them as well.
Which is why I go back to thanking millennials and Gen Z.
Yeah.
No thanks to Gen X, because we didn't really stand up for ourselves very well.
Okay, I don't buy that. I'm going to defend Gen X. I think we're the greatest generation. No offense to, the boomers or whoever had that moniker before then.
We had free-range childhoods, right? We could go run around in the streets and everything.
You've never met my mother.
All right, let's shift gears and take a look at how markets closed on the day and on the week. It was a down day and a down week for U.S. equities. The S&P 500 backing off from its record high, despite a Goldilocks job report.
Where exactly were you wandering around, Scarlett?
I was wandering I was riding the bicycle around my, town and everything.
Okay.
But kids played on the street back then.
Right.
They don't do that now.
They do not.
They go to Russian math. They go to Taekwondo. They go to violin lessons. They go to orchestra. They go to year-round soccer, for that matter. All right. Also, Bitcoin did hit 70,000, but it backed off. But I don't have that here. Apple broke its 7-day losing streak. Imagine that. This is The Close on Bloomberg.
My purpose tonight is to wake up the Congress and alert the American people that this is no ordinary moment. My message to President Putin, who I've known for a long time, is simple. We will not walk away. Like most Americans, I believe Roe v. Wade got it right. Whether young or old, I've always known what endures. I've known our North Star. Americans pay more for prescription drugs than anywhere in the world. It's wrong, and I'm ending it. My predecessor, a former Republican president, tells Putin, quote, do whatever the hell you want. I think it's outrageous, it's dangerous, and it's unacceptable.
A fired up President Biden there. Of course, he gave the State of the Union speech last night, which comes as the Senate aims to pass a $460 billion government funding package today in order to avoid a partial shutdown this weekend. Let's bring this all together with Balance of Power co-host Kayleigh Lines in Washington. So that State of the Union was really, it set the tone for campaign season for President Biden and Kamala Harris. But we got news today that No Labels, a centrist group, is still going to move forward with fielding a nominee. Who is likely to join their ticket? We know that Nikki Haley has bowed out completely, right?
Yeah, that's the million-dollar question, Scarlett. Granted, No Labels to some extent is just being true to its word here, because they had always said if it looked like it was going to be a Trump-Biden matchup in November after Super Tuesday, that they were going to run a so-called unity ticket. They won't want both a Democrat and a Republican on this ticket. And yet it's really not clear who that person is going to be. Joe Manchin has said no. Mitt Romney has said no. Larry Hogan has said no. He's running for Senate in Maryland instead. Nikki Haley and Dean Phillips, both of whom dropped out of the presidential campaign this week, both suggested they do not want to be on this ticket. And there are many others as well who have kind of shunned the idea of No Labels, because there is a lot of concern, specifically on the Democratic side, that all this ticket will do is pull votes from President Biden. There is reporting from the Wall Street Journal today that one of the names this organization is considering is Jeff Duncan, a former lieutenant governor of Georgia. Doesn't have a lot of national name recognition. You'd probably have to spend a lot of money in order to get that name ID out there, introduce this individual to voters. And of course, you still need someone else on the ticket on the other side. And we just have no idea what that is going to look like at this point.
Yeah, Jeff Duncan. Yeah, sorry, Kayleigh. I was busy looking up Wikipedia on him. It'll be interesting to see if they take that choice here in a national race. I am curious as we just kind of look ahead to what's going on in Washington, and more importantly, what's going on outside of Washington. The president gave that speech last night, as is traditional. Usually he'll, sort of hit the road, if you will, to try to sell folks on his economic agenda and whatnot. He's also got a budget proposal that he's also got to make public at some point as well. When do we get that?
We're expecting that Monday. And as you say, Romaine, in fact, the president is in Pennsylvania, a key swing state today. He'll be making next week a trip to a series of other swing states, including Georgia and Michigan and Minnesota. And all of it is going to be, kind of touting this economic messaging. And we do expect that budget on Monday will include some of what he outlined at his address last night, including on tax policy, higher corporate taxes, higher taxes on billionaires, that sort of thing. But it's worth keeping in mind he will present that budget when Congress has not yet actually passed the appropriations for the fiscal year We are almost halfway through right now. And the Senate is supposed to vote to continue to fund the government past midnight tonight, at least 6 parts of it. There's a 6-bill minibus package that passed the House. It's running into a little bit of hiccup in the Senate over amendment vote, so it's unclear the timeline of when the vote for final passage actually could happen. But there is a chance this actually runs into the weekend. So mechanically, the effects of a partial shutdown may have to start going into place if they can't get that done by midnight tonight.
Okay, that's a good reminder that this is not a done deal just yet. Very quickly, Kaylee, what is this I hear about a potential bill on TikTok?
It passed the House Energy and Commerce Committee this week unanimously. This is almost an unseen show of bipartisanship in Washington these days. A 50-0 vote that would essentially say TikTok would be banned from U.S. app stores if ByteDance, its Chinese owner, does not divest it. Now, Steve Scalise, the number 2 in the House, has said he will be bringing this to a full House floor vote next week, and then it would go to the Senate. And I spoke with Senator Shelley Moore Capito last night, who sits on the Senate Commerce Committee. She said she would gladly vote for this bill. She wasn't sure if it would pass the full Senate, but she thought it was incredibly important. And we heard from President Biden today. He said, if Congress passes this, I will sign it.
Yeah, absolutely. Kaylee Lyons, co-host of Balance of Power. Nice preview here of some of the things to expect coming out of Washington over the next few days, weeks, and months. When we come back after the break right here on The Close, we're going to set you up for what financial markets are really going to be honed in for the week ahead. This is Bloomberg.
People have often said Hollywood is like high school with money. So if that's the case, then these campaigns are kind of like class president for that same high school. It is very much like a political campaign.
It's a bit more chic, obviously, than the Iowa caucuses, but in another sense, it's the exact same thing.
And while no one has the power to buy an Oscar, campaigning for one is expensive.
The Oscars are very much the Super Bowl of entertainment. It's able to bring in about $150 million just for that one night alone, with roughly each 30-second ad spot going at about $2 million.
There is a whole industry of awards campaigning that surrounds the Oscars.
It's almost like event planning plus the advertising around said event. All of that money does flow through town.
There's certainly a lot of money spent on ads.
If you asked me how much money would it cost to win an Oscar, I would ask you, what's your budget?
I don't know about you, but I am super excited for the Oscars. I mean, the red carpet thing, and at least the opening monologue, and then it gets really boring until the very end again.
Who do you think is going to win Best Picture?
Best Picture, Oppenheimer.
You think Oppenheimer?
Yeah, I think
it's going to
back.
edge out Barbie.
I mean, I'd rather Barbie win, but I'm pretty sure Oppenheimer will.
All right. Well, the Oscars, of course, are on Sunday. Not necessarily market moving, but maybe some implications here if you're into media stocks or something like that. A few other market moving events as well going on in the week ahead, including Joe Biden and his budget proposal set to drop on Monday.
Yeah, this is a wish list, so I don't see it as something that's going to move the markets, but, we'll get a sense of what the president's priorities are going to be in the following year.
That's exactly what it's intended to do. And then later in the week, we're going to get more inflation data, including CPI report on Tuesday.
Yeah, this is one of the last big data points for the Federal Reserve before their FOMC meeting. And the consensus estimate right now is for the headline number to grow 3.1% in the month of February. And if you back out energy and food prices, grow 3.7%.
It'll be interesting to see what it does. Remember the big shock that we had on the last CPI, PPI, and retail sales reports. And now we get fresh reports on all three of those, including PPI and retail sales on Thursday.
Yeah. How much longer can the consumer drive the economy and drive sales and drive growth at this point?
All right. And we're going to get maybe a closer look at some of those retail sales, if you will. But from the earnings perspective, quite a few earnings next week. And that includes names like Kohl's.
Yeah. KSS, the ticker there. Also On Holdings, the Swiss sneaker maker.
You have those sneakers too?
No, but I look at them all the time. And, I don't know if they're worth the price tag.
And you're going to Dollar General, Dollar Tree also going to report in the retail space. And then a few tech companies as well, including Oracle, as well as Adobe and ADM. How about ADM? That's
ADM's going to be a mess, right?
Yeah.
Given all the accounting issues that they've been facing.
All right. Well, definitely tune into Bloomberg because you're not going to get any better coverage of all of those earnings and more than right here on Bloomberg Television. Balance of Power is coming up next for all your political coverage. Join us next week. We'll be back then. This is Bloomberg.